Catch market is locked.
Hmm.
S&P 500 closes up 1.7% at 7,437.63. The Dow adds 1.2% to print, 52,208.06. And the Nasdaq just ripped 2.8% into the close to settle at 24,122.89.
Right, but you have to look at the internals.
We are exactly 15 minutes past the bell on this Thursday, July 30th, 2026. I mean, the MOC imbalance is printed heavily on the buy side. Textbook key reversal erasing yesterday's Fed liquidation. Volume confirmation is absolutely there.
Is it, though? Because the real risk here is taking those headline prints at face value. You look at a 2.8% move on the Nasdaq and call it a breakout, right?
Well, the prints held the extreme upper decile straight through the 4.0 BM bell. You really can't deny the strength.
I'm not denying the index strength. I'm saying you look beneath the surface, and it's an incredibly fragile market. It's, held together by one single ticker.
Microsoft.
Exactly. Strip out Microsoft's 16% surge today, and that entire Nasdaq tape looks fundamentally different. This wasn't some broad economic breakout. It was a targeted liquidity sweep into one fortified balance sheet.
Sure, but you can't ignore the gravity of that balance sheet. I mean, they surged 15.5% to 16.5% intraday. That is their strongest single-day performance since 2008.
Oh, yeah. Massive.
And the catalyst is undeniable. Azure crossed $100 billion in annual revenue for the first time. They posted EPS of $4.74, just completely annihilating the $4.25 consensus.
It's a fundamental re-rating of their operating leverage. Yeah.
Right. Institutions were basically forced to aggressively reweight their portfolios into the close because Microsoft finally answered the single biggest existential question hanging over this market. AI, ROI. Return on investment for AI.
Right, because for 24 months, asset managers have just been underwriting hundreds of billions in CapEx on faith. Data centers, silicon, power infrastructure.
The anxiety on the buy side was palpable.
Very. You could see it in the earnings calls last quarter. Analysts were demanding a timeline for margin accretion. They needed to know when the cash burn turns into actual free cash flow, and Microsoft provided the math today.
They showed that the enterprise-level adoption of those AI copilots is actually driving margin expansion. Not just, top-line vanity metrics.
Right. And so institutional flow immediately migrates to where that margin expansion is proven. But it's a zero-sum game, right? The AI trade has officially bifurcated.
Which brings us to Meta. Because if Microsoft is the undisputed winner absorbing all that liquidity, Meta platforms became the primary funding source for that rotation.
Down 8.8% today.
Yeah, a severe haircut.
Because market mechanics are ruthless. Meta walked into their earnings call and announced a $31.08 billion quarterly CapEx, explicitly earmarked for their AI build-out.
But with no immediate margin accretion to back it up.
Exactly. Zero near-term revenue clarity on how that $31 billion is going to hit the bottom line. The buy side looked at that CapEx run rate, looked at the lack of immediate monetization, and just instantly repriced the equity.
They executed a violent repricing because the tolerance for theoretical growth is just entirely gone.
Precisely. Wall Street is no longer buying a ticker just because management says artificial intelligence 4 times on an earnings call. Portfolio managers are aggressively bidding up proven infrastructure players with visible operating leverage.
And ruthlessly liquidating anyone engaged in unchecked CapEx without a clear path to monetization.
The penalty for burning cash on speculative AI models just went exponential.
And, we have to contextualize that ruthlessness within today's macroeconomic data.
Yeah.
Because this explosive tech rally happened against a backdrop of objectively deteriorating growth.
Oh, the macro data is incredibly soft right now.
Right. The Q2 U.S. GDP print came in soft this morning at 1.5%, materially missing the 1.8% consensus.
Right.
And on top of that, we have core PCE inflation stuck at a highly sticky 3.3% year over year. Even though the June month-over-month print was a mild 0.1%, it's still sticky.
Yeah.
So we have slowing growth and sticky inflation. The classical playbook says that is a stagflationary setup, which should be toxic for equity multiples.
It should be toxic, but the institutional reaction function has inverted. When the broader macro data decelerates, real money doesn't rotate into cyclicals, industrials, or small caps. They run from them.
Right. They look at a 1.5% GDP print and realize the consumer is cracking.
So they hide in megacap tech. Microsoft is no longer being traded as a high beta growth asset. It is being utilized as a defensive duration asset. That $100 billion cloud revenue stream operates almost independent of the U.S. consumer credit cycle. It's basically a sovereign balance sheet at this point.
A safe haven trade disguised as a growth breakout.
Completely. And the only reason they had the clearance to execute that rotation today was the stabilization in the bond market. Long-term Treasury yields found a ceiling after yesterday's spike, and Brent crude eased back to about the $89 per barrel level.
Right, that localized drop in energy removed the immediate fear of a stagflationary spiral. It gave algorithmic buyers the green light to initiate long exposure in big tech.
But if you look beneath the surface of that long exposure, the breadth internals from today's session are flashing severe structural warnings.
Yeah, the headline S&P 500 prints a 1.7% gain, but the institutional briefings show that nearly 65% of the S&P 500 components actually closed in the red today.
Which is the definition of a concentration trap. It's a total liquidity vacuum beneath the top 5 names.
Two-thirds of the index lost value today. It is entirely a function of market cap weighting mechanics.
Right. When a multi-trillion-dollar entity like Microsoft gaps up 16%, the algorithmic arbitrage required to keep ETFs balanced physically drags the index higher.
It completely overrides the selling pressure in the other 495 stocks.
It does. And the discrepancy in the small cap data today highlights exactly how chaotic this underlying rotation really was.
Yeah, this was wild. OneDesk's strategy briefing cites the Russell 2000 climbing 1.4% today, while the quantitative intermediate briefing shows the Russell dropping 1.61%.
That is not just a clerical error. That data fracture tells a very specific story about institutional execution at the close. When you have a massive reversal day driven by a single tech constituent, ETF rebalancing at the 4:00 p.m. bell creates extreme tracking errors.
So algorithmic desks are forced to dump illiquid small caps to fund their mandatory mega cap allocations.
Exactly. What that negative 1.61% internal print tells you is that active managers were unloading risk across the broader market all day long.
Even as the headline index pushed higher, the broader market is not participating in this rally.
Which creates an incredibly precarious setup for tomorrow's session. The structural integrity of this entire market is resting on a fraction of a millimeter of support.
Especially with those looming late-day prints from Apple and Amazon.
Right. If either of those names show weakness in their forward guidance, or if institutional funds decide to execute a sell-the-news liquidation to lock in today's gains, there is absolutely no broad-based bid beneath this market to absorb the selling pressure.
65% of the S&P is already effectively in a downtrend.
If the mega cap floor gives way, the resultant air pocket will be violent.
The options market, however, is not currently pricing in that violence. The VIX, the 30-day implied volatility index, suffered a massive crush today, plummeting 14% to settle at 17.77.
Well, that VIX crush is purely the mechanical unwinding of event risk premiums. Going into Wednesday's Federal Reserve decision and today's Microsoft print, institutions were aggressively hedging.
They were heavily buying out-of-the-money put options to cap their downside risk, just in case the Fed signaled a hike or Azure growth collapsed.
Right. And when both of those events passed without triggering a systemic shock, those hedges became unnecessary.
The uncertainty was removed from the board, so traders systematically liquidated their downside protection. And when you sell a put option, the market maker on the other side of that trade has to adjust their delta exposure.
Which mechanically requires them to buy the underlying index futures, further accelerating the rally.
Exactly. And that leads us into the most critical structural dynamic in the market right now: dealer positioning. The briefings emphasize a specific mathematical threshold, the zero gamma flip level, often colloquially referred to as the put wall.
Right. And to understand why this dictates the day two play tomorrow, you really have to understand how market makers actually manage risk.
Let's break down the mechanics of that delta hedging. Market makers are not taking proprietary bets on market direction. Their mandate is to remain delta neutral and collect the bid-ask spread.
Right.
When they sell options to institutions, they take on directional risk, which they immediately hedge by buying or selling the underlying stock. Gamma is simply the rate of change of that delta exposure.
Exactly. When the S&P is trading above the zero gamma flip level, market makers are in a state of positive gamma. Mathematically, this means as the market rallies, their delta exposure forces them to sell into the strength to stay neutral.
And when the market dips, their algorithms mandate that they buy into the weakness.
Right, so they act as a structural dampener. They are artificially suppressing realized volatility by mechanically buying every dip and selling every rip.
It bounds the market in a very tight, mean reverting range.
Yes, but the danger lies in crossing that threshold. If the market sells off and we breach the zero gamma flip level, dealer positioning inverts into negative gamma.
And this is where dealer reflexivity takes over.
In a negative gamma regime, the math forces market makers to sell the underlying asset as it falls and buy it as it rises.
So they are no longer dampening volatility, they are exacerbating it. Their mandatory hedging actually accelerates the directional momentum, creating those massive liquidity cascades we see during rapid sell-offs.
Exactly. But the primary takeaway from the options desk is that today's massive rally pushed us comfortably back into a positive gamma regime. As long as the S&P holds above that zero gamma level tomorrow, we're structurally insulated from a reflexive crash,
The dealer hedging will force range-bound consolidation.
which directly informs the institutional playbook for the day two play. The statistical probability models in the briefing suggest only a 30% to 35% chance of trend continuation tomorrow.
Versus a 65% to 70% probability of consolidation or mean reversion.
Right. Knowing that dealer gamma is going to suppress directional momentum, chasing a gap-up open tomorrow morning is statistically a low expectancy trade.
You never blindly chase the day two open after a 3 standard deviation move.
No. You watch for institutional accumulation signals. When a megacap prints the kind of structural shift Microsoft did today, large asset managers cannot build their target positions in a single session.
If a mutual fund needs to acquire 10 million shares, executing that entirely on day one would incur massive slippage and ruin their average cost.
They use algorithmic execution to slice that order over several days, and the primary benchmark those execution algorithms use is VWAP, the volume-weighted average price.
Right, VWAP represents the true average price a stock traded at throughout the day, accounting for volume at every price level. Institutions grade their execution desks on whether they can buy a stock below the day's VWAP.
Exactly. So the high conviction setup for tomorrow on the long side involves monitoring the winners that traded on massive relative volume today, anything doing 2 or 3 times its 30-day average volume.
You want to see the stock gap up pre-market and hold firmly above the prior day's VWAP.
If it holds that level, it proves that institutional bid is still sitting in the dark pools, passively absorbing all retail profit-taking. The trigger is a sustained breakout above the first 15-minute high of the regular session, anticipating a multi-day institutional drift higher.
The mechanics for the downside, however, are just as rigid. Look at Teladoc Health. The stock was just eviscerated today, down 26.8% following a catastrophic cut to forward guidance.
Yeah, a liquidation of that magnitude almost guarantees forced selling will bleed into the second trading session as risk managers force PMs to cut their losses.
So for a day two breakdown setup on a name like Teladoc, you do not short the opening gap down.
No, you wait for the dead cat bounce. You watch for a weak morning rally that attempts to test prior day resistance levels.
And when that bounce stalls out and gets rejected, because trapped longs from yesterday use any slight uptick as an exit liquidity event.
You initiate the short position as it breaks back below the day one low. That confirms the institutional liquidation flow has resumed.
It all comes down to waiting for volume confirmation at key structural levels. But, the briefings also detail one specific macro-level options strategy designed to exploit today's VIX crush.
The asymmetric volatility trade?
Right, because implied volatility was systematically destroyed today, options premiums, the actual cost to buy a contract, are sitting at relative discounts.
And this is where you deploy defined risk spreads, specifically debit spreads or calendar spreads. When you buy a standard call option, you are fighting time decay theta, and you are exposed to further volatility crush vega.
If the market chops sideways, your option bleeds value every single day.
But a spread mitigates that structural disadvantage. In a debit spread, you purchase an option close to the current price and simultaneously sell an option further out of the money.
By selling that further out contract, you are collecting premium that finances your long position.
You are capping your maximum potential profit, yes, but you are drastically reducing your cost basis. And more importantly, because you're both long and short an option, your exposure to volatility crush is neutralized.
You are isolating your bet purely on directional movement.
In an environment where the VIX is compressed at 17.77, deploying debit spreads allows you to position for an explosive breakout in either direction with strictly capped downside risk, without paying exorbitant event risk premiums.
It is a highly calculated, capital-efficient method for stepping in front of potential dealer reflexivity. All right, we need to wrap up the post-market analysis. The closing print is a Microsoft-engineered reversal day on heavy volume, confirming a ruthless bifurcation in the AI trade.
Capital is instantly migrating toward proven operating leverage and violently rotating out of speculative CapEx.
Right, but beneath the Nasdaq's 2.8% surge, market breadth is profoundly negative, with 65% of S&P components closing in the red, masking a broader economic sensitivity to stagflationary data.
And this leaves us with the ultimate structural risk to model going into the rest of the year. We are watching hundreds of billions of dollars in CapEx being spent by tech giants to build out AI infrastructure.
Microsoft proved they can monetize it, which justifies their valuation today.
But the entire ecosystem currently looks like a closed-loop economy. Tech companies are buying silicon from NVIDIA to build servers, to sell cloud compute to other tech companies who are training models to sell to other tech companies.
Right.
If the ultimate end user, the non-tech enterprise consumer, does not begin adopting these AI applications at a scale that generates trillions in net new economic productivity,
Then this entire CapEx cycle isn't a technological revolution.
it is just a circular revenue illusion. And the moment that CapEx loop breaks, the margin accretion driving the 7,400 S&P print vanishes with it.
A closed-loop ecosystem highly vulnerable to an end-user demand shock. We will track the pre-market view app levels on Apple and Amazon tomorrow to see if that ecosystem holds. That is the closing tape. Execute accordingly.